Okay, a very good evening, everyone. My name is Imran from Kenanga Futures 𝐻𝐭𝐲 𝐓𝐫𝐾𝐬. For your information, today's session is a joint collaboration with Chicago Mercantile Exchange Group. This webinar is to create awareness and provide educational on listed derivatives to the participants. And also, please take note that the futures and options trading involves substantial risk due to the leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures 𝐻𝐭𝐲 accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. And today we are fortunate to have a speaker to join us for this session. Without further ado, let me introduce 𝐿𝐮. 𝐿𝐮 is a senior executive from sales and broking at Kenanga Futures. And if you have any questions, please feel free to drop in the chat or use our Q&A or use the Q&A section later. Right, thank you. 𝐿𝐮, over to you.
Hello. Can you see me and can you hear me?
Yes, 𝐿𝐮, we can hear you.
Okay, great. Okay. So thank you, Imran. Hello and good evening to all. Thanks to Imran for the introductions. So I hope everyone had a good day today. So today's session is going to be a light and easy webinar. And my name is 𝐿𝐮. I'm a senior executive sales and broking retail listed derivative with Kenanga Futures. So in today's webinar, I will be sharing with you on Futures 101. So a basic understanding on futures. So a quick disclaimer, these sessions will be a basic introductions to futures. For those who have experience in trading futures before this, I'm afraid this might not meet your expectations. However, do note that we will be doing more advanced webinar in the coming futures. So you can stay tuned for that advanced webinar. Before we start, a disclaimer that this session is purely for educational purposes only. So I'll go through this copyright and disclaimer point. So no part of this document may be reproduced, distributed, or transmitted in any form or by any means, including photocopying, recording, or other electronic or mechanical methods, without the prior written permission of Kenanga Futures Sdn Bhd. Disclaimer: futures and options trading involve substantial risk due to the leverage factor and may not be suitable for all investors. Only risk capital should be used when trading futures and options, as investors could lose more money than their initial investment. Investors are responsible to consider carefully the inherent risks of such investment in light of your financial condition and are strongly encouraged to seek professional advice regarding the appropriateness of investing in derivative or any investment strategies discussed or recommended. The content provided in this document are intended solely for information and education purpose. Although every precaution has been taken to verify the accuracy of the information contained herein, Kenanga Futures Sdn Bhd assume no responsibility for any error or omissions. No liability is assumed for damages or losses that may result from the use of information contained within it. Neither the information nor any opinion expressed constitute an offer or an invitation to make an offer to buy or sell any investment or any options, futures, or derivative related to such investment. Moving forward, for today's agenda, we will go through introduction to derivative and futures, understanding margin, product offering, new futures contract, trade a slice of 4 most liquid futures contract, and also a little bit on history data case study on Dow Jones futures. If you have any questions, you can just drop it in the Q&A box. We will go through it at the end of the sessions. So firstly, introduction to futures. What is derivative? So basically, derivative is refer to a financial instrument used to manage portfolio or investment exposure to a volatile market. So the product under derivative can be derived on an underlying instrument. It can be commodities, interest rate, index, or stocks. And derivative is widely practiced as a tool for hedging, speculating, and also arbitraging. Moving forward, what is futures? So basically, futures is a standardized contract between two parties who agree to buy or sell a specific product which is the underlying asset, with a specific quantity and quality of the current price to be delivered on the designated futures date. So futures is a legal contract to buy or sell a specific product. This product can be any commodity. It can be index. As I mentioned before, it can be index, stock, interest rate, or also commodity. So common commodities that you might be familiar with might be crude oil or soybean oil. And there are many more futures contracts. We will go through other contracts later in the webinar. So all futures contracts have a contract mind, specifying the expiry date of each futures contract and how it will be settled on the expiry date based on the contract specification set by the exchange. So, for example, let's say I'll be the buyer and you will be the seller. So we will make a contract with you. I will make a contract with you to buy an apple. Let's say you sell an apple. I made a contract to buy an apple with you, assuming that I'll buy a contract I'll buy an apple at ringgit in 2 months' time. So let's say the apple that you are selling, the price dropped to 70 cents in 2 months' time. So I still have the obligation to buy the apple at ringgit due to the contract that we have made earlier. So this is technically how futures contract work. You put in position to buy or sell a specific product at a predetermined price for a futures date later on. So commodity futures contract is an agreement to buy or sell particular commodity at a future date. Moving on, I'm pretty sure maybe most of you are familiar with equities and maybe new to futures. So let me share with you what's are the difference between futures and also equities. So for futures contract, as stated before, as mentioned before, it's an agreement for you to buy or for you to sell an underlying asset where its value derived from. So like I mentioned, it could be commodities index or stocks. And while equities, you are buying or selling shares of the listed company. For futures, the contract is standardized between two parties. For futures, it is a standardized contract between two parties who agree to buy or sell a specific product with a specific quantity and quality at the current price to be delivered on the designated futures date. While for equities, it is a shares represent an ownership of the company, and you are one of the shareholder of the company. As a shareholder, you have the right for voting. Usually for futures contract, right? People are typically trade for short-term trading due to the contract months, so they have expiry. While for equity, trader will hold the stock for a long-term trading because so long the stock is still in the exchange, you can still trade the shares. And for futures, it's aiming to benefit for the right direction of the price movement of the underlying asset, while for equity, you aim to benefit from business success and the reward will come in the form of increase in share price or also distributions of financial profit as dividend. Okay, let's move on to characteristic of derivative. There's two kind of derivative. One is listed derivative and another one is over the counter. So for listed derivative, it is exchange traded, meaning you trade the contract on an exchange and they have a standard terms regulated. They are also regulated and also settled by a clearing house. For example, it's a future contract. So it can be crude oil futures, it can be soybean oil futures. While over the counter, they are not listed on an exchange. They don't have a standardized term. You can customize the contract, and this contract is negotiated privately and involve counterparty risk. For example, it's a forward contract. For us, we are only dealing with listed derivatives. So let's move on to the futures contract specifications. Because I have mentioned contract month earlier, let me go through some of the other specifications under futures contract. So futures contract specification describe the standard element of a future product. There are underlying assets, contract size, minimum price fluctuations, contract month, final trading day or maturity. So unlike securities, futures contract have a standard specifications. An exchange traded futures contract have a specific quality, quantity, physical delivery time, and a location for the given product. So for the underlying asset, this one mean that the underlying asset is the financial asset or commodity that the future contract based on. For let's use crude oil as an example for this slide. So the underlying asset for crude oil futures is crude oil itself, and the contract size for the crude oil, which is the amount of the underlying asset that is deliverable or covered by the futures contract. The contract size is 100 barrels per contract, and the minimum price fluctuation is the minimum price movement of a future contract, also called a point or a tick, how much it move per tick. And the contract months, the months where the futures contract expires and when the settlement or delivery take place. Active contract months have the highest open interest volume. I will show you an example of the active contract month where you can identify which one is the most active. And lastly is the final trading day or the maturity. The trading of the futures product will be ceased after the final trading day. There is a final settlement value for all the open position and have to be settled either by cash or physical delivery. So, like I mentioned before, for example, the product can be a commodity product, like and then we use crude oil as example, right? So the underlying is crude oil. The underlying of futures, crude oil futures is crude oil. The contract size is 1,000 barrel, and the contract month that you traded, like put as example March, and so the specification of the contract are all identical for all participants. This help buyer or seller to easily transfer contract ownership to another party by way of trading. The only variable is the price, which is determined by bidding and offering. Let's look at the example of contract mine for micro oil futures, because I want to show you the open interest. So contract mine for micro crude oil futures is monthly contract listed for the current year, and the next 3 calendar years list monthly contract for a new calendar year following the terminations of trading in the December contract of the current year. Let's assume that current month is September 24. So I've screenshot the contract months that we have in our KDF trade active. So if you can see here, the open interest, the highest open interest is for micro crude oil November 2024. The volume is 11,286. So this is the highest, meaning this is the most active contract for this month. Okay, that's all for the contract month example. So now let's move on to why you want to trade futures. So this is why you want to trade futures. So basically, it helps with risk management. So market participant can use futures to hedge against market risk and also exposure. In times of anticipated and unanticipated event-driven volatility in their overall market. So you can use futures for your risk management. And moreover, futures is also highly liquid. Most futures market are highly liquid. They provide narrow bid-ask spreads and allow large position to be cleared out easily without any adverse impact on prices. And for futures trading, we have lower capital. Futures trading use leverages, requiring a margin of 3 to 12% depending on the contract's notional value. This allows traders to control larger position with less capital. So I will give you an example on the leverage later on. For futures, you can also do short selling. So it's permitted and viable in futures contract, enabling market participant to enter market regardless of direction, even in the bearish condition. You can also use futures for the portfolio diversifications. Futures market offer diversification across commodities, currencies, interest rates, and stock indexes, enabling traders to diversify their portfolio. Lastly, futures have a global market access. Futures market operate continuously across multiple time zones. granting traders access to global opportunities irrespective of their geographic location. So you can trade almost 24 hours for futures, depending on which contract and which exchange you go for. So who use futures to trade? We have three: hedger, speculator, and arbitrager. So hedger is basically the producer of the community of financial institutions who trade futures contract to protect themselves from future price fluctuation in relevant product. Example, agricultural producer and financial institution. So agricultural producer can be farmer, oil companies, mining companies, and others. Agricultural producer. Financial institution can be bank, fund managers, and also broking firm. While speculator include almost any investor, it can also be individual. They simply try to make profit from a bull or bear market. So basically, bull market is when you buy a futures contract when they expect the rise in price, while bear market, the traders will sell a future contract if they expect a fall in price. An arbitrager, investor who attempt to profit from price inefficiencies in the market to capture risk-free profit. They seek out price discrepancies between stocks through buying an undervalued share on one exchange while short the same number of overvalued share on another exchange. Let me walk you through on how futures work during by benefiting from bull market. So when bull market, like I mentioned before, when it's bull going up, you buy a future contract. So you put in a buy order. So buy meaning long. So you are long a futures contract. You make a money when price increase, price rise. So a long position is established when the trader buy a future contract, anticipating that the market will rise, the market will go up. So you put in a buy order. So here I put in E-mini Dow as our example. So you buy one E-mini Dow at $33,220. And then when you want to close your position, you sell it and the market actually going up. So you sell it at 33,300. Then you will make a gross profit of you make an increase of 80 index point times the contract size, which is $5 per contract. Then you make a gross profit of $400. And when can you make a benefit from bear market? Bear market is when the market is going down, when the market is falling. So you put in a sell order. So you do short selling. So you are short selling. We are using the same example. We are short one E-mini Dow. We sell one E-mini Dow at 33,400 and the market going down. And so we close our position by offsetting it, but we buy one E-mini Dow at 33,220. So the price difference there is 180 index point. And then we times by the contract size, which is $5. Your gross profit here is $900. So during a short position, you are establishing when a trader sell a futures contract, anticipating that the market will fall. So if you have any questions here, feel free to drop it in the Q&A. I will answer it later. So now we will move on to the product that Kenanga offer, that what we have here in Kenanga Futures Sdn Bhd. We offer 3 exchanges: Bursa Malaysia, Hong Kong, and also CME Group. So Bursa Malaysia, we have equity, commodity, financial. And on Hong Kong, we have index, equity index. For CME, we have a lot more. We have equity index, energy, metal, agricultural, and also interest rate. As Imran mentioned earlier, we are collaborating with CME. We go through one by one on the contract that we offer later on. Okay, so now let's move on the regulatory bodies of derivative market in the United States of America, because we're talking about CME Group. So Commodity Futures Trading Commission is one of the regulatory body. The Commodity Futures Trading Commission is an independent federal agency that regulates the derivative market, including futures contract, option, and swaps in the United States. Their mission is to protect market user and the public from fraud, manipulations, abusive practice related to the sale of commodity futures and options. And it also includes their goal to foster open, competitive, and financially sound commodity futures and option markets. Next one is CME, Chicago Mercantile Exchange. They are one of the largest and most diverse derivative marketplace. They offer the widest range of global benchmark product across all major asset classes, including futures and options, based on interest rate, equity index, foreign exchange, energy, agricultural product, and also metal. They also provide electronic trading globally on its CME Globex platform. They also provide clearing and settlement services across asset classes for exchange traded and over-the-counter derivative through its clearinghouse, CME Clearing. And they are comprises of 4 exchange. We have CME, CBOT, which is CBOT, NYMEX, and also COMEX. So now let's move on to understanding margin. I've mentioned leverage earlier in the earlier slide. So what is margin? Margin is in equity, they allow investor to finance from a broker to purchase the securities. The investor is required to deposit a certain percentage of the total purchase price, known as the margin of financing, and the remaining balance is financed by the broker. However, for futures margin, margin is an initial deposit required by the traders before initiating a futures position. So you need to put in a margin before you can initiate any futures position. Unlike equities margin, this is not a down payment, but a security deposit to ensure the performance of the contract, and you do not gain ownership of the underlying asset. Usually, futures margin represent a smaller percentage of the contract notional value compared to the potential certain percentage margin requirement for the securities purchase on margin. So for example, we use E-mini DAO as example. So the contract notional value currently is 40,195 value index point times the contract multiplier, which is $5. The value is at 200,975 and margin requirement per contract as of now is at $10,780. So if you look into this, the margin percentage that you need to put in is only 18.64% from the actual contract notional value. So it's much more smaller than the actual contract value lah. So how does margin work? So let's see margin call. So assuming that you are trading E-mini DAO and it is currently trading at 40,915 per metric ton, and the 10,780, assuming you put initial deposit 10,780, which is the exact amount of the initial margin. So you open the position by longing one E-mini DAO at 40,915, which is the market price. So when the market closed, it went down to $40,855. So here you can see you're making a paper loss of 60 index point. Times by 5, your paper loss is at $300. Your current net equity stand at 10,480, which is below your required maintenance margin, which your maintenance margin, it should be 10,708 ringgit. So therefore, you will need to add a balance of 300 or more to meet your margin requirement. So usually, we will advise our traders to put in a little bit more than the initial margin to act as a buffer if this thing happen. Let's see the scenario for margin surplus. So assuming that you are trading E-mini Dow and it is currently trading at 40,855 index point, you intend to trade 10 contracts of E-mini Dow. So the initial margin currently is 10,780 per contract, and you put in, and the initial deposit that you are required to put in is 10,780 times 10 contract. You are required to put in 107,800, and then you buy 10 E-mini Dow at 40,855. So when the market closed, it went up to 41,300. And the paper gain that you are gaining is 445 index point times 5, which is the contract multiplier, times 10 contract. You are making a paper gain of 22,250. And your current net equity stand at 130,050, which is above your required maintenance margin. Therefore, you have a surplus of 22,250. Here you can, with the surplus, you can add in another contract to trade if you want. So let's move on to the next slide, which is CME Group product offering KFSB. So the product that we offer for CME Group that we have here in Kenanga. So we have a lot of CME Group here. So there's equity index. So under equity, we have E-mini Dow Futures, Micro E-mini Dow Futures, E-mini S&P 500, Micro E-mini S&P 500, E-mini Nasdaq 100, Micro E-mini Nasdaq 100 Futures, Nikkei USD Futures, Micro E-mini Russell 2000. We also have energy, crude oil futures, E-mini crude oil, micro crude oil, natural gas, gasoline, heating oil, and also burn less financial futures. And then metal, we have gold futures, micro gold futures, silver, copper, platinum futures. We also offer agricultural or livestock. We have corn futures, mini corn futures, wheat futures, mini wheat futures, soybean meal, soybean oil, live cattle. We also have a new feeder cattle futures. We also bring in, this one is technically new. We bring in this year, the feeder cattle futures. Interest rate, we have treasury notes, futures, 2 years, 5 years, 10 years, 30 years, and we also have ultra 10 years US treasury notes. So there's a lot of CME product here offered in Kenanga Futures. So the one that I have highlighted, the yellow one, E-mini Dow, crude oil futures, and also gold futures, I will go through with you guys later on the why you need to trade it and also the contract spec. So let's see. So now we start with E-mini Dow futures. So E-mini Dow is one of the most efficient and cost-effective way to gain market exposure to the Dow Jones Industrial Average. So you will gain exposure to 30 of the largest companies in the US economy, and it acts as an indicator on the health of the US stock market. They also trade, E-mini Dow also trade electronically nearly 24 hours a day, 6 days a week, and allowing short position without stock loans and variable fees. It allows traders or investors to hedge their macro exposure or capitalize on anticipated movement in DJI index, especially around major market movement events. An objective of E-mini Dow, it gives short-term traders the ability to engage the DJI without having to tie up extensive risk capital by the purchase of large cap stock. So basically, when you trade E-mini Dow futures, you are basically trading 30 of the largest company in a basket. So the contract specification for E-mini Dow, the exchange is CME, and the underlying product is Dow Jones Industrial Average. Contract unit is DJIE times $5. Minimum price fluctuation is 1 index point equal to $5. Contract month is the calendar quarterly months are March, June, September, and December. Final trading day is Thursday before the third Friday of the contract month. Trading hours, Malaysian time. The first session is 6 a.m. to 4:15 a.m. Second session start at 4:30 a.m. until 5 a.m. And margin requirement as of now is 10,780. And the settlement method is cash settle. Disclaimer, for retail client, all settlement method is cash settle. We do have physical settlement and cash settlement, but all contract for retail client is cash settle. Why do you want to trade E-mini DAO? So they are traded electronically on CME Globex. It also one of the greater capital efficiency. They allow you to gain exposure to all 30 DAO listed company trading on a single contract. So I'm not sure if you can see the company list that I have put it here. So you can see there's American Express, Apple, Caterpillar, Chevron, Cisco, Coca-Cola. There's a lot of well-known company here: IBM, Intel, Johnson & Johnson, JP Morgan Chase, McDonald's, Microsoft, Nike, Procter and Gamble. There's a lot of high cap company listed in the Dow Jones. So moving forward, let's talk about crude oil futures. So crude oil futures contract offer participants the opportunity to trade one of the world's most liquid oil futures in an electronic marketplace. The contract not only brings the benefit of electronic trading as trading a US-like sweet crude maker, but it also brings together the world's three most significant oil benchmark on a single exchange: Brent, Middle East sour crude, and WTI. WTI crude is a light sweet crude oil blend. Light refer to low density and sulfur content. The major trading and delivery hub for WTI crude is at Cushing, Oklahoma for North American oil. So the contract spec for crude oil futures is WTI crude oil. The contract unit is 1,000 barrels. Minimum price fluctuation for crude oil futures is 0.01 USD $10. Value per tick is $1,000. Contract monthly contract listed for the current year and the next 10 years, and 2 additional contract months. List monthly contract for a new calendar year and 2 additional contract months following the termination of trading in the December contract of the current year. Final trading day. The final trading day is the third business day prior to the 25th calendar day of the month preceding to the delivery month. Trading hours, Malaysian time, is 5 a.m. until the next 5 a.m. 6 a.m. until 5 a.m. Margin requirement is currently at 7,260. Settlement method is delivery settle, but I've mentioned before, for retail, it's only cash settle. So you need to close your position before the contract expired. And then why do you want to trade crude oil futures? So crude oil is traded electronically on CME Globex. They allow public to trade nearly 24 hours a day, and they have a higher liquidity. It is the most popular traded physical commodity on the globe. So it's easier for you to go in and go out because they are highly liquid. Next, let's move on to gold futures. CME Gold product provide global price discovery and opportunities for portfolio diversification by presenting an alternative to gold bullion, coins, and mining stock investment. Gold offer ongoing trading opportunities as gold price respond quickly to political and economic events. Gold also are a popular anti-inflation hedge. They are leading liquidity and also greater capital efficiency. So instead of holding a physical gold, you also have an option to trade gold's futures in a futures contract. So you don't have to hold the actual gold. The contract specification, the underlying product is gold. The contract unit is 100 troy ounce. Minimum price fluctuation is $10. 0.10 equal to $10. Value per tick is $100. Contract monthly contract listed for 3 consecutive months, any Feb, April, August, October in the nearest 23 months, and any June and December in the nearest 72 months. Final trading day, third last business day of the contract month. While the trading hours is 6 a.m. until the next 5 a.m. And there might be a 1 hour behind for daylight saving time. Margin requirement currently is at 9,130. And settlement method is physically settled. Why do you want to trade gold futures? There are also you also have global access to gold futures. They are traded electronically on CME Globex. They are one of product that you can use to hedge against inflation. They allow public to take advantage of opportunity in nearly all market conditions. They also one of the alternative to a physical gold. Gold futures allow public to have a variety of alternative in terms of convenience and expenses. And they are one of the leading liquidity so gold futures is highly liquid and allow for easy entry and exit positions due to its attractive underlying assets. Okay, so I've showed you the contract specifications, and if you notice here, the margin requirement for most of the product that I've mentioned is quite high. So I will introduce you to trade a slice of the 4 most liquid futures product. So a slice meaning in a much more lower range in terms of the margin requirement. So understanding micro futures contract. So it provides market participant an efficient and cost-effective way to gain exposure to a variety of market. They also offer the same benefit of their larger contract portfolio. This also works for you to diversify your portfolio. It also help to you to manage your risk, their liquidity and accessibility, and also speculative opportunity. So one of the example is S&P 500 futures. If you notice earlier when I show you CME group product, there are micro and E-mini. There are E-mini and also micro S&P. So what are the difference between these two is contract unit, minimum price fluctuations, and value per tick, and also required margin. So micro E-mini is much more smaller in terms of all those 4 items. So for E-mini S&P, the larger contract, the contract unit is $50 times S&P 500 index, while micro is $5 times S&P 500 index. While the minimum price fluctuations for my E-mini is $12.50, and for micro E-mini it's $1.25. So it's much more smaller for micro E-mini, and value per tick also smaller. So E-mini value per tick is $50, while micro E-mini is $5. And the margin requirement is 12,980, almost 13,000 for E-mini S&P 500, while for micro E-mini it's only $1,298 per contract. So it's much more smaller for you to trade per contract to put in the margin. Next, Dow Jones Industrial Index Futures. We also have 2 sizes, E-mini Dow Jones and also micro E-mini Dow Jones. So for E-mini Dow Jones, the contract unit is $5 times DJIA. The minimum price fluctuation is 1 index point equal to $5. Value per tick is $5. While for micro E-mini, the contract unit is 0.5 times Dow Jones Industrial Average. Minimum price fluctuation is 50 cents, and value per tick is also 50 cents. You can see the margin requirement for E-mini Dow is 8,800, and micro E-mini is only 924, so much more smaller. So if you want to trade E-mini Dow, but you don't want to put in this much margin, you can start with micro E-mini. And next, we also have crude oil futures. There are three contract size: crude oil futures, E-mini crude oil futures, and micro crude oil futures. So for crude oil futures, the big size, the big contract unit is 1,000 barrel. For the medium contract is 500 barrel. For the smallest contract is 100 barrels. And the minimum price fluctuations for crude oil futures is $10. E-mini crude oil is $5, and micro E-mini is $1. While the value per tick for crude oil, the big contract is $1,000. The medium contract, the medium size contract is 500, and the smallest is $100. Margin requirement is for the big size crude oil futures is 7,260, while the middle one, the E-mini crude oil futures is $3,630, and micro E-mini crude oil, the smallest one, is only $726. And the difference between the big contract and the two small contract is that the big contract is physically settled, and the two mini contract is cash settled. The last contract is gold futures. So we have gold, the big contract gold, and also the micro gold. So the contract unit for the big gold contract is 100 troy ounces, while the micro gold is only 10 troy ounces. So, and then the minimum price fluctuation for the big contract is 0.1 per troy ounces equal to $10, while the micro one is 0.1 per troy ounces equal to $1. And value per tick is $100, while for micro gold is only $10. And then the margin requirement for gold futures is 9,130, and the margin requirement for gold futures is 9,130, while the micro gold is only 913. So they are much more smaller. So if you are not familiar but want to trade CME, you can start with the smaller contract because you don't have to put in that much margin requirements. You can put in a fractions of margin requirement from the actual big size contract. And most of these four contract, all of them are highly liquid, so they are active. That is all for CME contract. So now the last part, the case study part. So I'll talk about Dow Jones because that is the most recent events, which happened on August. So what happened was that Dow plunges more than 1,000 points amid fear of US economic slowdown. Usually, if you look into the market, the Dow Jones price movement can be more than 100 points, but 1,000 points is quite big. So we can look into this, and what happened actually is that the slump of over 1,000 points amid worries over US economy, which sparked a worldwide sell-off. So people are panic selling. This is the worst fall since 2022 amid global rout, which have been driving down the stock. The stock lost ground on Thursday after a weak report on manufacturing and construction. Moreover, on Friday, the government data showed that hiring last month was far weaker than expected, and the main factor that has staying power is the economic slowdown. So people are panic selling due to the economic of US time. So if you can see here in the screen, I have screenshot the candlestick of the E-mini Dow. So you can see that this is the 1,000 points. This is the 1,000 point fall. So during this you can take the opportunity to do short selling. So let's look into the key takeaway from the event. So the Dow Jones is one of the most followed equity indexes. They are tracking 30 largest cap, well-known companies that trade on US stock exchange. Dow Jones stumbled more than 1,000 points amid growing fears of an economic downturn sparked by a slowdown in hiring and consumer spending. So what can you do during these events? Do take note that this doesn't always happen. So during this event, you can take the opportunity from the bear market by initiating a short position, and you can also monitor the news and the current event for the futures market movement. You can take advantage from this event and predict what will the US market be like in the futures. And you can from here you can also identify the factors that affects the contract market movement. So that is all from me. If you have any questions, feel free to drop it down in the chat box. Imran, over to you.
Okay. Okay. Thank you, Naili. Definitely a fruitful session for all of us. Just for your information, we are currently running a CME mastering futures campaign from the 19th August 2024 to the 15th November to 2024. So an initial deposit of RM10 ringgit is only required to open an account, and successful account opening you have to trade one contract of CME products to be rewarded with a guaranteed of 100 ringgit touch and go credit vouchers. This is applicable for the first 88 successful account opening. And additionally, with every successful account registered, you will get a free basic recorded e-learning video from our verified speaker, which is have 18 years experience. And lastly, the top 10 in the highest volume traded for CME contracts will win a 2-day future trading masterclass as the grand prize. Okay, now let's look into the question that's been posted from our audience. We will go to the chat and see what question has been posted. Naili, maybe you can answer what has. We have questions from Muhammad Izzuddin. Okay, hi, I have a question. Why FCPO contracts active month is every 3 months? That's our first question. Okay, can you see this question?
Yeah. So I look into the chat, right?
Yep, chat.
Okay. Why FCPO contract active month is every 3 months? So FCPO, typically the first and second contract months have lower liquidity, and the third month is the most traded. And if you look into the if you look into the wait, let me share. Can you still see my
Yeah, we can
presentations?
see your slide. Yeah, we can see the deck.
Let me see, where is it? Okay. This is an example for micro crude oil, but it's the same for FCPO as well. So to see which one is the active contract month is open interest. So usually the active one is the one with the highest open interest. Why is it the most highest? Is because as most trader and hedger favor the third month for its greater price stability and also the deeper liquidity. So more people trading, and meaning there are more liquid, so it's easy for you to go in and out. And the first and second month are primarily utilized by physical market participants, such as producer and buyer focus on the actual delivery of palm oil. As I've mentioned earlier, all of futures contract have expiry date. So for us retailer, we don't participate in the delivery of it. So that's why retailer mostly traded a further contract. As a result, this month see less speculative trading activity, leading to the lower overall volume. Am I answering your questions, Izzuddin? For your first question?
If you are here, you can maybe you can respond in the chat whether Naili has answered your questions.
Okay. So can we move on to the next question, Imran?
Yeah, the next question is from Izzuddin as well. How Bursa decides the margin amount for each products?
Okay. How Bursa decide? Okay, so Bursa determine their margins amount for each product based on the risk assessment of price volatility, market condition, and the specific contract characteristic. The margin is set to cover potential losses in case of adverse price movement, and they regularly review their their and adjust their margin according to market volatility and also liquidity. Moreover, Bursa may use risk model like SPAN, standard portfolio analysis of risk, to calculate the margin requirement based on worst case scenario.
Okay, that will be for the second question, and that has been answered by Naili. And the third question would be, actually we have two more questions, but this is the third and the fourth one. So the third one is, if the larger futures product are Sharia compliance, for the micro future also Sharia compliance?
For Sharia compliance product, we need to confirm on whether they are Sharia compliance or not. But most micro contracts are financially settled, setting them apart from the standard full size futures contract. So I will update you on whether the micro futures are Sharia compliance or not. We will send you an email. Will that be okay? Because we need to confirm again whether the contract is Sharia or not.
And then for the last question, okay, we have another question. We have something. Okay, Mr. Izzuddin has an answer. Okay. Okay. So, okay. And for the last question is from Mr. Hafiz. He's asking that which product is Sharia compliance?
I need
Okay,
to
so
check again with you on which CME product is Sharia compliance.
would that be okay, Mr. Hafiz? That we will get back to you on that. Okay, is there any other questions that you may have for us before we end the session for tonight? We'll just give it another 2 more minutes if anybody has questions for Naili, and we'll try to answer our very best. We'll try our very best to answer the questions. Okay, from Mr. Hafiz, where and how to trade CME products? Naili, over to you.
You can open an account with us, then you can trade CME product. As Imran mentioned earlier, to open an account is only 10 ringgit during this campaign period. So if you don't have, if you want to trade CME product, if you are interested to trade CME product, you can open an account with us. We can assist you from there. Any further questions? So
Okay. What is the brokerage fee for CME products?
So the futures product, right? We don't have uh a set brokerage fees. So different product have a different brokerage fee. So I need to know specific which product you are interested in. Will you be okay if I contact you, give you a call? How about crude palm oil and soil? So crude palm oil and soil. Let me check this. Crude oil, not FCU, crude oil futures. Crude oil futures now, our rate is $12 per contract. That is for voice executions. But for online, it's $10 per contract per site. Do I answer your questions? ARF, ARF. Are you familiar with futures trading? ARF? Okay, do we have any more questions?
Okay,
Any-
Nayeli, we have one more question. We have we have two actually. Number one is any promotions for existing client. That's number one from Yung. Okay, and then one more is from 𝐲𝐬𝐧𝐠. Do you have reminders recommendation under Kenanga to teach more about futures product?
We have a campaign. We are running a campaign now, right, Imran? So for existing client, can you share the campaign details on the existing client?
Okay, I will share the visual at the
Yeah,
chat.
the visual of it.
Right.
For Muhammad Izzuddin, right? Do you have a reminder? May I know where are you from? And do you have account with this? Because now we are offering 10 ringgit to open account, and you will also get a one-on-one teaching, a video recording from Benny Lee. He's a very good teacher. He will teach you about basic on futures and also basic introduction to futures. Much more detailed than what I've shared today. So that might be helpful as well. But if you want a one-on-one reminder, I need to check on that first.
So okay, 𝐲𝐬𝐧𝐠, once you have if you're our customer, then it's good. But if you're a new customer, then we will be offering a free basic class which will cover the entire basic of trading in futures trading. Where if you are successful onboarded, once you have successful onboarded with Kenanga Futures. Is there any other questions that we can answer? Okay, from AF, does Kenanga offer half margins for CME products?
As of now, no, we don't offer half margin for CME product. Okay, let me share with you guys our campaign. We are running a mastering futures. Imran mentioned earlier. So for our existing client, trade and stand a chance to win 2-day trading masterclass worth of 2,000 ringgit. So if you trade the highest of CME product, you will stand a chance to win a masterclass with Benny Lee. And yeah, if you open an account, if you're a new customer, you open an account with us, you win 100 𝐻𝐶 wallet credit voucher for the first 88 successful account opening. So you open an account with us and trade one CME group product, you will entitle for 100 ringgit 𝐻𝐶 credit. But this is only for the first 88 successful account opening. And moreover on that, you will get basic recording e-learning videos. This campaign is on CME product. Do we have any other questions?
Okay, calling once, calling twice. Okay. Okay, I think there's no further question. Is there any last question on the campaign or we can answer before we end the session? Okay, I think we've come to an end of our session. So if you have any further questions, you may email us at futuresmarketing@kenanga.com.my. And with that, we will end the session. And thank you everyone for joining us tonight. And and don't forget to join our Mastering Futures campaign. Thank you so much, everyone. Good night. Thank you.
Thank you all. Bye.
Thank you all. Bye.